Hey YouTube, this is Zach with Achilles Financial, and today we're going to be talking about the red hot Chinese electric vehicle, also known as EV stocks. And in particular, we're going to be looking at NIO and XPENG. Those trade under the ticker symbols NIO for NIO and XPEV for XPENG. So today, the reason that we're going to be talking about them is because there's been a lot of moves in these industries over the past few weeks, and there are a lot of different ways to play them, and I'm going to be giving you a few safer options to be playing the options trades, although at the end of the day you have to remember that options trading is increasingly more risky than just holding the underlying shares. However, I do think that there are strategic advantages to utilizing options in your trading strategy, so make sure that before you make any trades you are actively looking at how to approach them. So first off, let's talk about NIO. As you can see over the past 2 weeks, NIO has been slowly but surely going down. However, that halt came today, kind of around the $40 strike price, was somewhat surprising to me considering the fact that they just issued an additional share offering at $39 a share, which was less than where they were trading by a fairly significant margin, nothing crazy, but still lower than 5% or so. And you can see that that's continued to have a negative effect on the stock. So I see a lot of people out there that are still very bullish on NIO, and they're saying that this is the time to buy. I personally am not going to be playing either of the two trades that I showed today, but I still think there's a lot of opportunity there. I just have not traded any of the Chinese EV stocks, and my EV exposure right now is limited to covered calls on IDEX or Ideanomics. However, let me show you some of the ways that you can approach a NIO strategy. We're going to be using the same strategy that we used on DraftKings 2 months ago, and if you want to know how that worked out, you can see I'm using my paper money strategy right here, and you can see that on DraftKings we actually sold 10 cash secured puts, which were up $6,200 on those, which is the equivalent of right at 46%. And we're also up entirely 23.32 on the underlying shares. So you can see overall on that investment, we're up $11,000. However, recognizing that this is fake money, what can we actually do? Let's take a look at NIO, and you can price this accordingly to your individual shares and your risk capability. So what we're going to look at is actually doing a cash secured put. So I'm going to sell a put, and what I'm actually going to be looking at doing is going much farther out of the money and much farther out of time. So if we think that we are incredibly bullish on the stock, we can actually go to January 21st of not 2021, but 2022. What that gives you the capability of doing is saying that if I think the stock is going to be higher than $40 a share, someone will actually pay you $1,500. So just right off the bat, if the stock is currently trading at $41.17, you do not have to buy a single share. You just have to have $4,000 in cash to make this trade. However, if someone pays you $1,500, that would instantaneously be a 37.5% return on investment. So that would give you $1,500 cash that you could hold on to. So the way I'm getting those numbers, let me just show you the review piece. You can see that the cost would be someone paying me $1,500, or in this case $1,494.35. However, this would cost, the way that I would have to put this trade up is I would have to put $4,000 of collateral up, and that is the equivalent of 100 shares at $40 per price. So this is essentially saying that I am willing to pay for 100 shares if next year during the same time period the stock price is under $40 a share. So if you're bullish on the stock and think it's going to go up, you're able to take advantage of the fact that people have been selling and selling, and so you're able to actually buy this or sell your $4,000 for a $1,500 premium. So let me show you how that works. You can see this chart right here that shows how much you make. You can see in the top left hand corner right here where my mouse is essentially how much money you would be earning during that point in time. So if at expiration the price is over that $40.69, you walk away with max profit at any point in time, which is at $1,500. However, as it starts going lower and lower, you're still profitable, still profitable, still profitable. The only way you are not profitable on this trade is if it goes under $25 and it appears 2 cents or so. $25.05, you will be profitable on this trade. So the stock will have to lose another 40% from where it's at today. After that, because you are buying the stock, as long as the company hasn't gone bankrupt and the stock is no longer here, then January of 2022, anytime the stock is under $40, you would be buying 100 shares at whatever that price is. However, the entire time you would have as much as $1,500. So if the stock price went up to $80 a share, it says right now that the profit loss would be $775. I anticipate that it would actually be higher than that just due to the volatility. So this is the way that you can make real income off of a trade without actually having to buy the shares. Again, it's called a cash secured put. You're saying, I'm willing to put my money up as a just in case. And then what we're doing right now is someone's paying that time premium of going all the way out to January 21st of 2022. We've seen a lot of success using DraftKings strategy doing that exact same thing. And I think there's a lot of capability to do so with NIO if you're bullish. And again, there's a lot that goes in there. So we've seen the 2-week chart for NIO that's been going down. I think the inverse of this, let's actually look at a different option strategy where we're looking at XPENG or XPEV. And you can see that they are actually starting this climb back up. You can actually see how they also were skyrocketed ahead. And I'm going to be going the opposite direction because as you can see in the top right hand corner, they are up 6.4%. What I would actually be doing is I would be purchasing 100 shares. So, or if you already have 100 shares, you can see right now that the 47.14 is up $2 today. So if we have another strong open today, what I would actually look at doing is going out to the end of the month and looking at the $50 option. That would be right at so if your initial investment is 100 shares at this price, $4,000, 714 cents. Then what you would be doing is instantaneously looking to flip that off of the upward advantage and sell this covered call that you see here on the screen. So what you would be doing is instantaneously making a profit or actually pulling in the balance that you see right here of $288. So I would be selling this. So you would hit sell 1 December 31 50. And what this would do is it would provide you if this profit went off, you would get a profit of $270 right from the trade. However, you would also get $286. So what a covered call is, again, is you are selling your right to hold those shares. So if the stock goes up to over $50 a share, you would get the difference between the current strike price of, I'm going to continue using the 47.14. So you would get $286 plus the $270 that you see on the screen right now, which would be $556 over the course of 2 weeks if it went over $50 a share. So that $556 would give you a total share price, or rather total profit of right at 12% over 2 weeks. However, let's say that the stock doesn't move at all. What you would actually do is you would just keep that $270, which would still give you a nice little profit of 5.7% all over 2 weeks. So I think there's a really strong advantage to using this strategy if you have the capital to get those 100 shares. The reason that I suggest this is because you're able to play some of these more highly volatile stocks and get guaranteed profits, guaranteed income, and this is a cool way to do so. Hypothetically speaking, if you see swings like this, you're going to be able to generate that $270 I see. You could do that as many as, or using this trade, 26 times a year. So again, if you just are looking at additional or the similar volatility, then you could potentially look at options that are anywhere between 5 to 10% out of the money. But if you just did 270 times 26, assuming twice a year, then you're instantaneously going to be looking at a $7,000 return. And that's assuming that the shares aren't moving during that same time or picking up additional volatility. So there's some assumptions there, but there's a great way to look at the passive income capabilities. So this is two different ways that you can look at how to play the stocks in terms of using either a cash secured put or a cash cover or a stock secured call. So both are really great options. If you have additional questions or would like to even ask my opinion on some of your trades, join that Discord below. And if you found this content helpful, please leave a like and subscribe. Thanks everyone. Talk to you later.